A Lamborghini dealership looks like the ultimate trophy business. Supercars gleam under dramatic showroom lighting. Millionaires walk in ready to spend 7 figures without blinking. From the outside, it looks like pure glamour and pure profit. Everyone assumes the owner is swimming in cash, but the real economics are far stranger than they appear. This is not a business built on thin margins. It is a business built on thin control. Control over inventory, control over allocation, control over brand image. Every one of those forms of control costs money to maintain. Behind every showroom sits a far more fragile machine than it looks. Today, we're uncovering the hidden economics of owning a Lamborghini dealership. And most people get this business backwards from the very first assumption. People assume owning a Lamborghini franchise means owning a money printer. The brand alone feels like an instant status symbol. Just holding the franchise rights feels like joining an exclusive club. Every car in the showroom looks like a massive profit event. A Huracan or Urus can list for over $250,000. A Revuelto can cross the $500,000 mark. Some limited edition models sell for well over $1 million each. The Urus SUV alone often accounts for the majority of units sold. It brought a completely new type of buyer into the brand. It is more accessible but still firmly in ultra-luxury territory. Multiply these sticker prices by dozens of units a year. The top-line revenue number looks enormous on paper. That number alone can make headlines and attract new investors. Investors see scarcity and assume automatic wealth. They imagine a business with almost no real competition. They picture buyers lining up, begging to pay full price. In some ways, that part is actually true. Lamborghini dealers rarely discount their inventory. Some dealers even charge above the official price, called a market adjustment. Waitlists for new models can stretch beyond a year. That creates a powerful illusion of total pricing power. Pricing power is only one piece of a much bigger puzzle. The real business lives in everything happening behind the showroom floor. And that hidden machinery is what most outsiders never see. Understanding that machinery is exactly what this video will do. Getting approved as a Lamborghini dealer is brutally difficult. Automobili Lamborghini tightly controls every new dealership location worldwide. The company handpicks who gets a franchise agreement. Most desirable territories are already locked to existing dealer groups. A new applicant usually needs deep automotive retail experience. Manufacturer approval alone can take years of negotiation. Financial strength has to be proven before construction even begins. Once approved, the real spending only just starts. Lamborghini enforces strict global showroom design standards. Every location must match a specific brand aesthetic. Think polished stone floors, dramatic lighting, and minimal clutter. Building or renovating to that standard is extremely expensive. A single flagship showroom can cost several $1 million to build. Land costs alone can rival the price of the building itself. Prime urban or luxury retail districts are non-negotiable requirements. A quiet suburban side street will never get approval. Manufacturers protect their brand image as fiercely as their car. Then comes the inventory floor plan on top of construction cost. Dealers must finance a rotating stock of 6-figure supercars. Even a small inventory can represent millions in floor plan debt. Every unsold car sitting on that floor plan burns interest daily. Total startup investment can range from $5 to $15 million. That range shifts heavily based on country and city. Roughly half of that investment often goes toward real estate alone. The remaining portion covers construction, equipment, and initial inventory. Some dealer groups lease their real estate to reduce upfront cost. Leasing lowers the barrier but adds a long-term rent obligation instead. A dealership in the Middle East may face different costs than one in Europe. A location in the United States may face different rules than one in Asia. Some ultra-prime global locations push costs even higher than that. This is not a business someone casually walks into. It is closer to buying a seat inside a private luxury club. And the manufacturer decides who is allowed to sit down. That gatekeeping is intentional, and it never fully goes away. Once the doors open, money flows through several different channels. New car sales are the most visible revenue stream, but the margin per car is smaller than most people assume. Lamborghini closely controls suggested pricing across global markets. Dealers earn a percentage margin plus manufacturer holdback. Holdback typically sits around 2 to 3% of the vehicle price. On a $300,000 car, that can mean serious reserve money. Holdback is paid back to the dealer after the sale closes. It rewards dealers for hitting volume and satisfaction targets. On top of that sit additional manufacturer incentives and bonuses. These bonuses often matter more than the sticker price margin itself. Used and pre-owned exotic sales add another layer of profit. A well-kept used Huracan can resell at surprisingly strong margins. Trade-ins let dealers buy low and resell noticeably higher. Financing arrangements bring in extra commissions for the dealer. Many buyers still finance despite paying cash-level prices upfront. Lamborghini's own financial arm often handles these loans. The finance company earns interest on nearly every financed sale. The dealer earns a smaller referral commission on top of that interest. Extended warranties and protection packages add almost pure profit. These add-ons often carry higher margins than the car itself. So the sticker price is only the beginning of the real story. Everything after the handshake is where the real money begins. The real profit engine actually sits inside the service department. Supercars require constant, highly specialized maintenance. Parts are exotic, expensive, and difficult to source elsewhere. Independent mechanics rarely have the tools to touch a Lamborghini engine that pushes almost every repair straight back to the dealership. Labor rates inside exotic service bays run extremely high. A single service visit can cost several $1,000s. Unlike new car sales, service margins stay consistently strong. This is where dealerships quietly stabilize their entire cash flow. Recurring service revenue does not depend on new car allocation. It keeps flowing year after year, regardless of sales cycle. The Urus also brings more frequent service visits than typical supercars. Daily driving on an SUV creates more routine maintenance work. Parts markup adds another steady layer on top of labor. A wealthy owner rarely questions a repair invoice closely. That pricing tolerance makes the service bay quietly very profitable. That single detail changes the entire profitability picture. Floor plan financing shapes almost every financial decision inside the business. Every car sitting on the lot accrues daily interest charges. Floor plan interest rates often move with broader lending conditions. A rate near 6 to 9% is not unusual in tighter markets. On $1 million of inventory, that adds up fast every month. The longer a car sits unsold, the more it costs the dealer. Fast inventory turnover becomes the real hidden skill in this industry. Lamborghini's naturally low production numbers actually help here. Limited global supply keeps demand high and turnover fast. This is very different from a typical mass-market car dealership. Mass-market dealers fight for volume and heavy discount pricing. Lamborghini dealers instead fight for allocation and priority access. Manufacturer allocation decides exactly which dealer receives which cars. Dealers often compete internally for the most desirable colors and configuration. A dealer with strong sales history gets first pick on rare allocation. Newer or weaker dealer often waits much longer for the same car. Strong-performing dealerships receive better allocation over time. Weak-performing locations can quietly slide to the back of the line. This allocation system gives the manufacturer enormous structural power. The dealer owns the building, but never truly owns the supply. That single fact defines almost every risk in this business. Every other risk in this business branches out from that one fact. Running the location day to day is far from cheap. Staff must be highly trained and highly compensated. Sales consultants need deep product knowledge and client relationship skills. Service technicians require specialized manufacturer-level certification. Facility upkeep must always match Lamborghini's premium global image. Lighting, flooring, and product displays require constant maintenance. Marketing spend often follows strict manufacturer co-op requirements. Dealers must contribute financially to approved brand campaigns. Client events like track days and factory tour also cost money. Insurance on high-value inventory is extremely expensive to maintain. A handful of parked supercars can represent millions in exposed risk. Security systems must match that same elevated level of risk. All of this stacks up long before a single car is ever sold. Lamborghini periodically updates its global showroom design standards. Dealers are expected to fund these upgrades entirely themselves. Refusing an upgrade can quietly damage the franchise relationship. Brand image compliance is not optional. It is contractual. Inventory carrying cost silently eats into every unsold month. When interest rates rise, holding inventory becomes noticeably more expensive. These are costs most outsiders never think to consider. On paper, the revenue numbers still look impressive every year. In reality, thin operational margins hide behind big sticker prices. The gap between revenue and real profit is wider than it looks. Picture two Lamborghini dealerships in two different cities. One sits in a fast-growing wealth hub with strong allocation. The other sits in a smaller market with slower demand. The first dealership turns inventory quickly and thrives. Second dealership carries cars longer and slowly bleeds cash. Same brand, same cars, completely different outcomes. Manufacturer allocation control remains the single biggest structural risk. A dealership can be highly capable and still receive limited cars. Regional exclusivity can shift if the manufacturer restructures territory. Losing exclusivity in one city can devastate a business overnight. Franchise agreements often include strict, unforgiving termination clauses. Persistent underperformance can end a dealership relationship completely. Economic downturns hit ultra-luxury demand harder than most expect. Exotic car buyers are wealthy, but not immune to market shocks. A stock market crash can freeze even the wealthiest buyers. The EV and hybrid transition adds another layer of uncertainty. Lamborghini has already begun shifting toward hybrid and electric models. Some traditional buyers resist that shift on emotional grounds. Dealers must now market a rapidly changing brand identity. Currency swings can also quietly affect global pricing and margins. A weak local currency can shrink profit on every imported car. Some markets also impose heavy import taxes on exotic vehicles. In certain countries, import duties can double the effective purchase price. That tax burden falls partly on the dealer's carrying cost too. Gray market resellers create another layer of unwanted competition. Some buyers flip allocation cars quickly for a quick profit. A practice can frustrate genuine buyers and damage dealer trust. Reputation risk is also brutally high inside this segment. One public service scandal can damage years of built trust. Wealthy clientele expect flawless, discreet treatment every single visit. A single bad experience can quietly cost future referral business. Many new entrants underestimate how allocation-dependent this business truly is. They assume high prices automatically guarantee high profit. They overlook how expensive ongoing facility compliance actually becomes. They underestimate the true cost of floor plan interest. Some owners overexpand into markets without enough sustained wealth nearby. A supercar dealership only works where real wealth density exists. Others fail to build a strong enough service department early on. Without deep service revenue, cash flow becomes fragile fast. A single slow sales quarter can strain the entire operation. Owners relying purely on new car margin often struggle first. Some owners chase the brand for prestige rather than solid strategy. Ego-driven expansion rarely survives a slow sales year. Owners who build strong client relationships tend to survive longer. The dealerships that last treat clients like long-term relationships, not transactions. They invest in trust long before they invest in inventory. That patience is often the real difference between failure and success. This is why so many outsiders misjudge this business completely. They see the car, not the machinery behind it. So is owning a Lamborghini dealership actually a good business? The honest answer is, it depends entirely on execution. It is not a guaranteed money printer, despite how it looks. It is a high-barrier, high-control, high-risk luxury operation. Success depends heavily on allocation, location, and operator skill. It also depends on manufacturer relationship and regional wealth density. Done well, it can generate strong, stable, long-term profit. Done poorly, the same brand power offers absolutely no protection. For the right operator in the right city, it can be lucrative. For the wrong operator, it can quietly drain millions before failing. Execution matters more than exclusivity in the end. The real profit secret is not the car sale itself. It is the recurring service relationship built quietly around it. That is the true engine behind Lamborghini dealership economics. Not the roar of the engine, but the hum of the service bay. And that is the part the showroom lights never show you. The badge on the wall never guarantees the number on the balance sheet.